Right, so let's begin the show, and we will be focusing on fixed income strategies for you, and we'll be decoding the growth and inflation trajectory as far as Indian economy is concerned, and keeping that in mind, the upcoming rate cut scenario that we might see. Let's decode all of this. I have with me Akhil Mittal, Senior Fund Manager, Fixed Income, Tata Mutual Fund. Akhil, hi, good evening, and welcome to the show. All right, so before we begin, in a nutshell, let's understand the RBI policy and the trajectory over inflation up ahead from the RBI's point of view.
Okay, so in the policy, I think RBI maintained a stance which was more pragmatic and to react post the numbers. So, yes, the growth has come down, but what was discomforting within RBI's space was the high inflation number, given that the last print they had was already above the trajectory which is allowed to RBI. Now, RBI has upped the full year inflation projection from 4.5 to 4.8%. But Q2 of FY26, they come down to 4%, which is the long-term target. Now, given this high inflation, it's important to decode where the inflation was coming from. And largest part of inflation was given by the vegetables and food. Hence, RBI, has maintained that since their target is a headline inflation number, they would want inflation to come down and be sure that they are progressing to achieve the target. So my sense is Jan, Feb, March, that is the time when your food inflation is also expected to come down. It will start coming off in December, but Jan, Feb, March, it will come down in a more rapid manner. And thereafter, we will see RBI being comfortable to ease the policy or cut the rates. As of now, RBI has stood its ground, but my sense is in February, it's highly likely that we get the first rate cut.
Right, Akhil, now keeping that in mind, what should be the ideal fixed income strategy or stance from an investor's point of view right now?
See, as far as fixed income investments goes, it's very simple that in a easing cycle, you need to elongate your maturities or elongate your duration, such that you don't face reinvestment risk. So more than capital gains, it is about the reinvestment risk. So if you have money which is longish term and not really short term, you need to invest in longer duration funds, longer duration instruments so that you capture the gains which are made out of fallen yields or fallen rates, and thereby negating any reinvestment risk through the capital gains you've already made. If you don't invest in longer term and there are rate cuts or the interest rates come down, what you end up doing is facing lots of reinvestment risk. So the next time you get your maturities, you have to reinvest them at a lower rate. So the ideal scenario is to increase the duration, stay in longest duration. And given the headline number of interest rate, risk-free interest rate in India, 10 years GSEC at let's say around 670, 675 band, I think it's a matter of time when we start the interest rate journey downwards. And my sense is over the next 2 3 years, it's going to be a steeper fall in interest rates, and hence it's imperative that one looks to increase the duration. Gilt funds use the long duration gilt funds, longer duration corporate bond funds, or any other funds which are available for in a longest duration within the mutual fund space. Or if you want to invest in other instruments of fixed income, you can go in for longer maturity instruments, bonds. That should be the right strategy as far as fixed income is concerned.
Time to go long as far as your debt mutual fund investment is concerned or fixed income investment is concerned. But then, we the CPI data is due for us now. Keeping that in mind, are we ready for a 50 BPS or a 25 BPS cut? What's going to be your analysis on this, Akhil?
My sense is by April we will have 50 bips. So either we are going to see a 25 bips each in February and April. And if December data on inflation does surprise us on the downside, I will not rule out a 50 basis in February itself. But having said that, it's just a matter of when and not a matter of if. So 50 basis over the next 6 months is what I'm looking at as a base case scenario.
in terms of boost, and I want to understand this question from an economy's point of view. How much of a relief are we looking at by this initial stages of rate cut? There are concerns of consumption going slow. We saw the GDP numbers. Definitely, the inflation is sticky, but then that's also that the concern might just ease off slightly if the CPI numbers come under the band of RBI, the comfort level of RBI. But then, what, according to you, can be an immediate sign of relief, by the initial rate cuts?
So the first thing that a rate cut helps is, the low hanging fruits of the housing sector getting, boost, because that is where the immediate EMIs reflect. You can have immediate boost up to consumption because that is where the lower strata or the middle strata of the society is more susceptible to. So you will have the base or the bottom of the pyramid kind of picking up along with the housing. The larger industry, larger sector, they more move on the longer term growth perspective, but the broader base is what will immediately take off. Also with rabi crops coming into the markets in Jan, Feb, March, a lower interest rate will obviously boost the consumption cycle over there or the minor investment cycle there. So these are the low hanging fruits which should immediately post a rate cut, see some kind of a green shoot signal, and some kind of a early boost to their economic activity.
All right, Akhil, I think that is all the time we have for the discussion on the show today. Thank you so much for taking time out and helping our viewers understand their strategies as far as fixed income is concerned. Time for a quick break, but then post that I'll be joined by Sameesha, who will be answering your portfolio queries. Just in case you want to get your investment strategies checked by our experts, you can send across your questions on our WhatsApp number, and you can also email us your question. The WhatsApp number is 865-797-4571. We also have an email ID, which is themoneyshow@etnow.tv. So a quick break and post that viewer queries up ahead.
If you like this video, then like, share and subscribe to ET Now.